Hello traders, Gary Wagner here. Approximately 11:20 in Honolulu, 4:20 in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is December 6th, 2017, and this is the Daily Report for Gold and Silver. What a week we have seen in the precious metals markets, U.S. equities markets, and the dollar, with gold and the rest of the precious metals complex coming under pressure today, provided by a strong U.S. dollar, but still showing net gains on the week. Now, for the second consecutive week, we have seen the precious metals move higher. Dow Jones Industrial Average flirting with 20,000. We've got a lot to cover, so let's get right to it. Gold finishing off on the day, closing lower by about $8.50 at $11.7280. It traded to a low of $11.71 and a high of $11.83 on the day. Net change was a decline of about 0.75%. So traders, I want to put today's trading activity not only in perspective of this week, but the last 2 weeks and the last month, month and a half. And this is what I'm talking about. The first chart I do want to look at is a daily standard candlestick chart. We can absolutely see that today's trading activity took this market lower, took it lower by about $8 on the day, closing out at $11.7280. Now, interestingly enough, the critical level that I am looking at currently sits roughly at $11.72. The market closed at $11.7280, so just above that particular price point. That's the first thing that we can see when we look at this in a cursory manner. The other thing that we can see is that over the last couple of weeks, and when I compress this to a weekly chart, it will even become clearer, but over the last couple of weeks, we not only formed a base back in December, but we have effectively traded above that and now are looking at 2 consecutive weeks of higher closes. And traders, as you can see, I have converted our daily chart to a weekly candlestick chart. And we talked about the fact the last couple of days, the pattern that we have identified on a weekly chart is a 3-river morning star. That would be these 3 weeks and these 3 candles here. And that comes as the culmination of the dramatic sell-off, which really began back in June and July, culminating in August, hitting these tops, and then beginning to flirt with lower pricing. Of course, the market found some stability roughly at about 1240 and then traded back higher, and that is up until Election Day. This, of course, this candle represents the week of the election, in which immediately following results, or as results were coming in, and it was first seen that Hillary Clinton really didn't have the presidential election wrapped up, and there was a possibility that Trump would be elected. We saw the market spike higher by about $40, $50. You can see that right here, only to close dramatically lower. And that really started a chain of events of 1, 2, 3, 4, 5, 6, 7 weeks with lower pricing, culminating on December 15th when we hit these intraday lows that came in roughly at about 1225. I think it was 1223 is actually the low that we hit. I am still under the assumption, and my model is still predicated on the belief, that we are, in terms of our Elliott wave count, that we are in a basic ABC pattern or correction. We've completed our A. That was the highs that were achieved mid-year last year. I believe also that we have completed the down leg of this particular pattern, which is our B wave, which culminated middle of December, and then beginning at the middle of December throughout the first week of this new year, which is our current action, we have a upward trend in play. Now, how long that trend will last is really the $64,000 question, because when we look at different periods of time, such as price action that occurred immediately before the election in November last year, you can see that the market had some solid gains. Really what you had here is almost a bearish harami, the confirmation. Then you had a couple of weeks of higher pricing, but that all stalled as soon as the election took place. So whether or not this will continue higher is something we'll have to see. But according to our model, we have entered a upward trend that should be sustained at least throughout the first half of the year, which takes us to our current trade. Of course, I did make a recommendation the other day to initiate long positions. And if you recall from the trade alert we sent out, I was specific in saying that you need to reserve at least half of your equity so that we can add to that position either on a dip or on a sustained rally. Now, we might in fact have seen some sort of a dip with the market closing off, as I said, by about $8. We are long at $11.80. Our stops are below $11.40, which puts our stops below the lows of this week's trading range, which to me is what is important. And therefore, my recommendation is to maintain our current long position, maintain our current stop. More importantly, if we get any kind of a dip come Monday or Tuesday, we will add and cost average our positions to a lower price. If we get the rally moving forward, we will keep pat with this one position and look for another dip to add to our current long gold and silver. Silver also trading lower, and as you can see, the net change in terms of reflection, also 0.75%, is almost all, or I should say is 100% due to a strengthening US dollar, because according to the Kitco Gold Index, both gold and silver had slight gains, fractional gains, but that was more than overcome by a strong US dollar. Silver closing off by about 12 cents at $16.51, and it's traded to a low of $16.26 and a high of $16.71. So traders, as far as silver goes, we are long roughly in this area. We are looking at a weekly chart, and a couple of things are quite apparent. First of all, like gold, we have our second consistent week of higher closes. We have a day in which the market closed softer on the day, but stronger on the week. We talked about, in terms of a weekly candlestick pattern that we identified, it would be based upon these three candles here. These two red candles here are called a bullish harami, which has an analogous trading pattern to the Western trader, and that is an inside trading day or trading week, as in this case, in which the range, the open and close, are within the range of the prior week's trading activity. We also had a solid break to the upside this week. Although it closed lower on the day, it still had significant gains on the week, and I think that most impressive and important is, like gold, when we look at the 61% retracement that is created from last year's trading range, we see that it did close, in fact, above that. Once again, maintain your current long silver as well as your stop. The big news today has absolutely been the Dow Jones Industrial Average, which came within mere fractions of a single point from reaching 20,000. High on the day, 19,999.63. So under a 0.4 of a point difference between 20,000 and the intraday high reached by the Dow. The Dow Jones Industrial Average flirting, no cigar, but flirting with 20,000. You can see that for the first time in history, we came so close. Traders could, in essence, almost taste it, but they left dateless, so to speak, as I said in my opening letter, with the Dow closing at 19,963. But you can see that in terms of our high, 19,999.63. So under a point separated a 20,000 point Dow. That, along with the strong US dollar, created the risk on environment that was so prevalent in terms of market sentiment today. However, in closing, I want to take a look at a dollar chart. I've just pulled up the monthly dollar chart. We'll convert it to a weekly because you're not seeing any kind of a net gain on the monthly. But take a look at the fact, although the month has just started, that we absolutely, even with this stronger close today, have, at least for now, on a monthly basis, and that's a real long-term chart, we have some real support roughly at 103.70, 103.61. That's evident within the monthly chart. When we convert that monthly to a weekly chart, the resistance is still quite evident. We can clearly see that with the series of highs that came in over the last month or 4 weeks of trading. We have a slightly higher close on the week, but I'm going to call that unchanged. And the other thing that I'm noticing, and we pointed this out to our daily subscribers, and that is in terms of a 3-day pattern in the dollar index on our weekly charts, we are seeing a three-river evening star. So we got a three-river morning star in gold. We got a bullish Harami confirmation in silver. We have a three-river evening star in the dollar, and although that did not confirm because we didn't get follow-through selling in the dollar this week, it is still, I believe, at a precarious position. And most importantly, when we consider that we are now literally 2 weeks away from a presidential inauguration in which we are going to put into office a president that has an untested resume, so to speak, in terms of leadership, in terms of politics, there is a lot of uncertainty in the air. And I believe that we haven't seen the entire scope of volatility that will emerge this next month as of yet. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you next week for another daily update and review. Bye-bye.